Superstars! Welcome to the Accounting Superstar Station. I'm Professor Don Bush, and I've been teaching accounting for about 30 years and have been a CPA for about that long, and I've got a lot of good ways to explain accounting, so welcome aboard here. What we're doing today is we're studying intermediate accounting, how to fix accounting errors. Now, sometimes when accounting errors happen, you wonder how in the world did people do this? And this mistake is kind of like that. You wonder, how did they make a mistake like this? But they did, and we need to fix it. So here we go. What I've got a 7-step process, and you might be thinking, oh my goodness, 7 steps to fix mistakes? Well, they go really, really fast, and after a while they become automatic and take maybe 2 seconds at most to do. So with a little practice, you'll get good at it. So fixing errors is a little bit like an art form. It takes a little practice and experience, but you can get the hang of it. So step number 1, here's what you need to do is you got to figure out, well, what did the company do? What did they not do? When did they discover the error? Well, apparently they made an error at the end of 2001. The error was discovered at the end of 2002. So what was the error? So here's the error. On December 31st, 2001, the company earned interest in the amount of $8,000. That should have been accrued during 2002. So they accrued interest in 2001, but they should have accrued it in 2002. The interest was earned during 2002, but was never recognized in 2002. When cash was collected in 2002, interest receivable was credited. Result: interest revenue in 2001 is overstated. So is profit. So is retained earnings. They're all overstated. And interest revenue in 2002 is understated. And finally, when was the error discovered? It was discovered at the end of 2002. And we want to fix errors just as quickly as we can, as soon as we discover them. So step number 2, were there any incorrect entries done? Not done. When? What were the incorrect entries? So you want to figure out, what did they do? What happened? What accounts are off? So here are the entries. On December 31st, 2001, they debited interest receivable and credited interest revenue for $8,000. That was the mistake. That was an adjusting entry right at the end of 2001. And that's what caused their interest revenue to be overstated in 2001. Now, in 2002, when the money came in, they debited cash, which they should have done, but they credited interest receivable for $8,000. So there you go. So there's the mistake. So step number 3 is, well, what correct journal entry should have been made? What should they have done? And the reason why I like to think about this step is it gives me something to aim at when I'm fixing mistakes. It lets me know what my target is, what I'm trying to do. And so here's what I'm trying to do. And this would have been the entry if they would have done it right. Well, on December 31st, 2001, there should not have been any entry at all. The interest was earned during 2002. So no entry on December 31st, 2001. They didn't earn any interest. But in 2002, what they should have done is they should have simply debited cash, credited interest revenue when they got the money. It was earned in 2002. In fact, you don't even need that account interest receivable at all. So here's the next step in the process. Well, are the books open or closed? This is important because this tells us if we have any flexibility in fixing these mistakes. So in 2001, the books are closed. Now what that means is you cannot make journal entries dated 2001. You cannot change journal entries dated 2001, and the income statement accounts have been closed to retained earnings. That means revenues, expenses, gains, losses, they've all been closed to retained earnings, and so that means they are totally off limits to changing or manipulating or correcting. Maybe manipulating is the wrong word, but correcting is the word that I really wanted. So in 2002, the books are still open. This is good. So the books are still open in 2002. So any incorrect entries in 2002, we can correct. So all accounts can be changed 2002 errors can be reversed out. I like doing it this way. It just helps me think things through. And it helps, and also you need to avoid creating new errors. And you need to double check your work, because sometimes when you're trying to correct the books, you actually make the books worse. And that's okay. It happens all the time. And all you have to do is reverse out what you did and start over and try something different. Step number 5. Now, this is the entry that I like to do. Your textbook does not teach it this way. So I'm sort of leaving the textbook method here, but I like the way I do it because it makes more sense to me and there's a good audit trail. So step number 5, if incorrect entry made in the current year and books are open, reverse out the incorrect entry made in the current year. So here's what I'm saying is, let's go back here to where the incorrect entries were done. So step number 2, the incorrect entries, well, in 2002, they debited cash and they credited interest receivable. Now, if we just reverse this out, it'll help clean up the books and it'll give us sort of a fresh start on redoing at least 2002. It's not going to help us with 2001 because the books are closed in 2001. So I'm going to reverse out this cash and interest receivable. So that gets rid of that bad entry and I can put in a good entry. So here we are. Here's where I reverse out the bad entry. So in 2002, I'm debiting interest receivable and crediting cash. And this helps me sort of start fresh and new. So the next thing that I do is for 2002 is I put in, well, what should have been the correct entry for 2002? And here it is. They should have debited cash for $8,000. They should have credited interest revenue for $8,000. And so that's how the entry should have been done. So I like doing that second here. So the last step is we have to make sure that everything's all cleaned up. Now, with this reversing entry, I caused this interest receivable to show up here. And so I need to get rid of that too. So interest receivable is being credited for $8,000. That gets rid of that up here. And my only choice here that I can work with is retained earnings of $8,000. And that's okay for another reason, is that retained earnings was overstated anyways at the end of 2001. Now, you might look at all these entries and you might say, wow, you're doing it the hard way here. And maybe I am a little bit. But I like doing it this way because there's an audit trail. If I have to explain this 6 months later, it's easy to follow and explain. And I also write really good explanations to my journal entries so that, because correcting entries are not typical standard everyday entries. They can get kind of weird. Now, some of you folks that are already pretty good at fixing errors, you might be able to see and say that, hey, it'd be so easy. Why don't you just credit interest revenue and debit retained earnings, and you'd be done with it, because all these other entries aren't really needed. And you are exactly right if that's the case. In fact, that's what you would see in your accounting textbook. But my entries and the textbook entries are totally 100% the same. Mine just look a little bit different here. So what if you do these entries my way and you want to make your answer look like the textbook answer? So that way your professor, your teacher will like what you're doing here. So it's real easy to do this. What you do is you combine these 3 entries into one big giant entry and see what you have here. So I did that down here in step 7. I combined those 3 entries into one big giant massive entry. And the reason why I did is this way I can simplify things. For instance, I've got interest receivable debited for $8,000. I've got interest receivable credited for $8,000. Well, what if I get rid of those two? I mean, they're being debited and credited for the same thing. Also, cash is being debited for $8,000. Cash is being credited for $8,000. What if I get rid of those two? Why not? You know, and what I'm left with is retained earnings of $8,000 and interest revenue of $8,000. And so that's the simplified part. And I put that right down here. So retained earnings, $8,000, interest revenue, $8,000. So when you're answering these problems, you kind of have a choice. You can either do it the way I like to do it. I like to reverse out the bad entries if I can and put in the good entries if I can, and make sure everything's all cleaned up. It just makes more sense to me. I'm able to think things through a little bit better this way. Or if you want, you can combine it all and just eliminate what you really don't need and just have the essence of the transaction right here, of the correcting entry. So there you go. Your textbook would look like this. They would debit retained earnings for $8,000, credit interest revenue for $8,000, and they would be done with it. When it comes to these correcting entries, use what works for you. So I hope that I've given you a few ideas of what you can do to fix errors and show you that there is some flexibility in doing this. And so use what works. So until next time, over